All right. Good evening, everyone. So, welcome to today's class. So let's see what we can cover for today. I'll be doing a recap of what we talked about yesterday, and then we'll move to what we'll be covering up for today. So, yesterday we discussed about chart patterns, and we said that chart patterns are the visual representation of price movements on a chart, and they are used to identify trends, predict predict future price movement, and also help traders make informed decisions. I will also talk about that there are different chart patterns we have, but I only gave like five examples of five chart patterns where I gave number one was the double top, which can also be called equal highs, and it looks like an M pattern. We also talk about the double bottom, which is the equal lows. And I said it looks like a W sign. Then we talked about the head and shoulder. We talked about the inverse head and shoulder. And the fifth one that we talked about was the multiple candlestick rejection. So this is an example of I think yesterday I didn't really show the um how it looks, how the head and shoulder pattern looks like. But I showed the double top, double bottom, the inverse head and shoulder. I think I didn't show for the main head and shoulder and the multiple candle rejection. So this is an example of a double top, and I said a double top when it happens, which it looks like whether equal highs, you can call it equal highs, or mostly look like an M pattern. So it happen when it happens at the top of an uptrend, it's signifying that a reversal is about to happen. So if we're going up in price, right, if we're going up in price and then this double bottom form, meaning that buyers are not able to continue pushing the price all the way up. So then this double top form, which looks like equal high, and then price reverse at that point and change to downtrend. So we're going up in the trend, and then later it changes to a bearish reversal, right? So that's an example of a double top. While for a double bottom, price was coming down, which was bearish, and then for some strange reason, price could not keep on push sellers could not keep on pushing the price down, and then it formed a double bottom, which is equal lows, and then changing from a downtrend to an uptrend, right? So that is an example of a double bottom. Now, the third one we talk about is the head and shoulder pattern. All right. So here is the head and shoulder pattern. And I said the head and shoulder pattern is a bearish reversal pattern, which occurs at the top of an uptrend as well. So now we're going up in price, right? We're going up in price, and then this happened. So you can see it changing from going up, right? It then from this is the left shoulder, this is the head, this is the right shoulder. So and we expect that price is going to, at least when it comes down, when it forms this head and shoulder, we expect price to pull up before going down. So this is an example of head and shoulder pattern. I'll show the example of this one shortly. So then we move to the fourth one, which we talk about the inverse head and shoulder, which is just the opposite of the main head and shoulder pattern. And we say the inverse head and shoulder pattern is a bullish reversal pattern which occurs at the bottom of a downtrend. So at some point, price was pulling down here, right? And then it formed this left shoulder. You can see the head, this is the right shoulder. And then it changes from coming down, and now it's going up, which is bullish. So it's after it formed this head and shoulder, you can see there was a retest, it's pull back down here before pulling up, right? So this is an example of inverse head and shoulder. And then we also talk about multiple candlestick rejection, which is this. So you can see it's price rejecting off. I just gave you this color. It can be that red, green, red, green. It can be pure green, it can be pure, just depending on how you see it on the chart. So these are when price is rejecting to probably keep on pushing up, right? So it's expecting at least for it to reverse to the downside. Why for this one is price was pulling down, right? And then at some point it started rejecting this lower point here, this support level, meaning that it's not able to continue pushing the price down, and then creating this long wick here, which is multiple candle wick rejection. So you might see more than three, you might see like 4 or 5, or mostly you can even see a lot of candles not able to continue pushing down, showing that a reversal might have happen in the market. So let's see the example of this head and shoulder, because I didn't talk about it in the last class. So let's see how the head and shoulder pattern looks like. Right, let's see how the head and shoulder pattern looks like. Okay, so I already gave a sign for it here. I was not able to cover it up yesterday. So this is an example. This is an example of a head and shoulder pattern. You may not really see it clearly like this, but if you look at it, it's more like it for me, a head and shoulder. At some point, right? At some point, so let's see if we can use the 4 hour time frame. Maybe you see it more clearly. Okay. So you can actually see it here as well, right? You can see it here more look like, but let's use this one here. If you okay, let's go to the 4 hour. Let me see if you can really see it clearly on the 4 hour. Okay, I think it looks much better like this. So at some points we were going up in price, right? At some point we were going up in price, right? Price was pulling up at this point, right? And then this where the head and shoulder pattern started forming. So this is the left shoulder, right? It came down, formed the head, which is the head here. It came down, formed the right shoulder as well, and then break of this neckline, right? You can see it broke, it came down here. And in what I showed you the last on the graph, I said that when it breaks this step, like there's high possibility that it will pull up again, a little bit up before it will start pulling down, which you see here, it started pulling down, right? It started pulling down. So you can see it started pulling down after this pattern form. So you can see it started pulling down. So that is how powerful the head and shoulder pattern can be, especially when they happen at key levels, meaning that when they happen at the top of an uptrend for a head and shoulder pattern, and for inverse head and shoulder pattern when they happen at the bottom of a downtrend. So today we'll be talking about, I hope this is clear. So today we're talking about Forex or currency pairs. So let me just put that down here. Let's see what we can cover up for today. It's so say we're talking about currency pairs, or either currency or Forex pair, whichever one you choose to call them. So let me just put Forex here. Forex in brackets. Yeah, okay, sure. Like this. So this is what we're talking about today. So let me increase the size of this so we can see it more clearly. Right. So let's see if we can increase the size. Let's choose 18. Okay, this is much better. So today we're talking about currency pairs. Currency pairs or Forex pairs, just depending on how you choose to call them. Well, this is what we're talking about today. Now, Forex pair okay, before then, now let's start with something. We have three major currency, three, like the currency pairs are divided out or are classified into three, right? They are classified into three. Number one, so currency pairs are divided into three, right? Number one, we have the major pairs. Number two, we have the minor pairs, right? Yes. And then the third one, we have the exotic pairs. So forex pairs are divided into three. Let me increase this a little. So forex pairs are divided into three. One is called the major pairs. The second one is called the minor pairs. And the third one is called the exotic pairs. Now, for the major pairs, right? For the major pairs, okay, let me make this one. So this will be more better to relate to it. So these are the three um the forex pairs is divided into or is classified into three. One being is called the major pairs, right? The second one is called the minor pairs, and the third one is called the exotic pairs. Now, for the major, let's start talking about from the first, we'll move to the second and then the third one. Now, major pairs, there are 7 major pairs or what currency pairs that are traded against the US dollar. Let me repeat myself. For the major pairs or major currency pairs, there are 7 world currency pairs that are traded against the US dollar. So they represent the largest and most commonly traded pairs in the world. Right, that's the major pairs. So the major pairs are there are 7 world currency and they are particularly traded against the US dollar. So they are mostly paired with the US dollar. These 7 major currency pairs, they're mostly paired with the US dollar and they represent the largest and most commonly traded pairs in the whole world. So now, what are these 7 major pairs? So that are traded against the US dollar. Now, the first one, let me reduce the size of this. So the first one we have, what I call it the first one. You have to choose to arrange it, it doesn't really matter. The euro, okay, let me use this to separate it. So we have the euro USD, right? The second one we have the GBP versus the US dollar. The third one we have the USD versus JPY with Japanese yen. We have the fourth one, we have the USD versus the Swiss franc. The fifth one, we have the USD versus the Canadian dollar. The sixth one, we have the Australian dollar versus the US dollar. And then the seventh one, we have the New Zealand dollar, versus the US dollar. So these are the 7 major currency pair that are traded against the US dollar. So let me just give some space between them. So this looks more better. Okay. So these are the 7 major currency pairs that are traded against the US dollar, and they represent the largest and most commonly traded pairs in the world, right? These 7. The first one, or you can whether the first one, depending on how you choose, it doesn't really matter. So what we have here is the euro versus the US dollar, the British pound versus the US dollar, USD JPY versus Japanese yen, the US dollar versus the CHF, which is the Swiss franc. The fifth one here, we have the US dollar versus the Canadian dollar. The sixth one, we have the Australian dollar versus the US dollar. And then the seventh one, we have the New Zealand dollar versus the US dollar. Now, these 7 pairs are traded against the US dollar because each of them, if you notice, each of them have the US dollar paired with them. Like they have US dollar attached with them. For the euro, it's paired with the US dollar. For the Great British pound, it's paired with the US dollar. For the Japanese yen, it's also paired with the US dollar. For the CHF, it's also paired with the US dollar. For the Canadian dollar, it's also paired with the US dollar. For the Australian dollar, it's also paired with the US dollar. And the last but not the least is the New Zealand dollar. You can see it's also paired with the US dollar. So these are traded against the US dollar. I don't know if I should really write it down, but let me see if I can just write some. So let's see if I can just let's say here is the euro versus, okay, let me still use this, versus the US dollar, right? Then the third one is the British pounds versus the US dollar. The third one we have here is the US dollar versus the Japanese yen. Display this Japanese yen. And then the fourth one here, we have the US dollar versus the Swiss franc. Right? The Swiss franc of our ELC. Then the fifth one here, we have the US dollar versus the Canadian dollar. Canadian dollar. And then, okay, we have the Australian dollar versus versus the US dollar. And then the last one have the New Zealand dollar. The New Zealand dollar versus the US dollar. So now this is just how the major currency pair are. So the major currency pairs, these are the world traded or the most traded currency pairs, and they are mostly traded against the US dollar. So you can see each of them have the US dollar attached with them. We have the Euro USD, GBP USD, USD JPY, USD CHF, USD CAD or USD CAD, AUD USD, and NZD USD. So these are the example of the major pairs. And now these major pairs, they are the most popular currency pairs because of their high volatility or high liquidity, because of their high liquidity, low spread, and also less volume, right? They have less volume when compared to other currency pairs. Now let's move to the second one, which is the minor pairs. So for the minor pairs, these are pairs, or these are currency pairs that do not involve the US dollar, but consist of the other two major currency pairs. I don't know if I should be writing this in English now, explaining this. Okay, let's see if we can be explaining each of them. Explain them. Okay, so for the major, yes. So let me just write a little bit about them. Now, this is there are 7 major world coins. I didn't want to cover up this, but let me just write it traded against the US dollar. And if you understand this, and they represent the largest and most traded, the most commonly traded shares. So this is for the major pairs. So for the minor pairs, right? Let's talk about the minor pairs. So now for the minor pairs, let's write some to English for the minor pairs. Now for the minor pairs, I'll send this into the group. So these are currency pairs that do not these are currency pairs that do not involve the US dollar, or they do not trade with the US dollar, right? That's the USD. Okay, let me put you back USD. I did not, but do anyhow, do consist, or are being traded, how you want to put it, or do consist of two major, let me put this in capital letter, two major currencies. Now I'm also going to give an example of this. Let's see. Now I said for the minor pairs, these are currency pairs that do not involve the US dollar. That means when they are paired, they are not paired with the US dollar, but they do consist of the two major currency pairs. For instance, now you can pair, because they say but do consist of two major currencies, meaning that there's when you're pairing the minor pairs, there's no US dollar attached with them. Not like you see here, they are traded against the US dollar. So each currency is attached with the US dollar here. But why for minor pairs, they do not have the US dollar attached with them. So or attached with them. So they are compared or consist of the other two major pairs. So let's give an example. So an example here, we'll have the Euro GBP, right, which is the Great British Pounds. Then we can also have the maybe let's say Euro JPY, right? We can also say the GBP JPY. We can also say AUD JPY, or you can say NZD. So just you can pair it anyhow you want to pair it, but just let the US dollar not be attached to this major pair. But you can pair. You can see all this one are example of. You can also even say GBP NZD. That's with the New Zealand dollar, right? So you can see things like this, but just have it in mind that we can even say GBP AUD. Guys, just pair the major two currency pairs together without the US dollar. This is just an example of minor pairs, right? This is an example of minor pairs. Then for the exotic pairs, now, okay, let me see, write some English for it. So for the exotic pairs, this small letter for this. I just want to beat up the time. We just have like few minutes. So for the exotic pairs, they consist of one major, right? Let me put this capital letter. One major currency and one currency from a developing or smaller economy. So this is an example of exotic pairs. So exotic pairs, they consist of one major currency and one currency from a developing country or a smaller economy. I know most of my Nigerian people will say, what about Nigeria Naira? I'm not saying the Nigerian Naira inside, or I'm not saying some smaller economic countries. Now, this is where they fall under the exotic pairs, because they consist of at least one major currency pair. That's one major currency pair from here, right? One major currency pair, they paired with another currency, again from a smaller or developing economy. So an example we have here is, now this where your Naira can come inside. We can have the USD, versus the TRY, which is the Turkish lira. I don't know if I should really write that, but you don't really need to even hold this thing. US dollar, versus the Turkish, because all these are smaller economy or developing economy. So you can see something like this. Then you can also see Euro ZAR, which is the South African rand. So which is the Euro, Euro versus compared with the South African rand. Then you can also see your USD, because we are pairing, you can just carry one of the major currency pair and just pair it with any smaller economy. So you can see the US, okay, let me put this in NGN. So this is the US dollar compared with the Nigerian NIGE, come on, with the Nigerian Naira. And then we can also pair, let's say GBP. You can also say GBP INR, which is the India, that's the British pound or the Great British pounds, versus the Indian rupees. Rupees. Something like this. So you can also see the US dollar maybe with the Singapore dollar. Guys, just pair any major currency pair with one currency pair from a developing or smaller economy. This is just what exotic pairs are, right? So major currency pair. There are seven in numbers. That's the most traded pairs against the US dollar, and they represent the largest and most commonly traded pairs. We have the Euro USD, GBP USD, USD JPY, USD CHF, USD CAD, AUD USD, SND, New Zealand dollar versus the US dollar. While for the minor pairs, these are pairs that do not involve the US dollar with it, but consists of two major currencies. For instance, the Euro GBP, which is Great British Pound, the GBP JPY, AUD USD, GBP NZD, GBP AUD. Just compare the other two major currency pairs, but without the US dollar. While for the exotic pairs, this consists of one major currency pair, right? Either one major meaning from here, right? One major currency pair, and then compared with a smaller or developing economy. For instance, like the South Africa, for instance, like Turkey, for instance, like Nigeria, Singapore, India, and many countries. As long as they are still developing and their economy is still small, or they have their economy is still developing, so you can just pair them with any major currency pair. That is for the exotic pairs, right? That is for the exotic pair. Now, I want to say something here. Now, this for every currency pair, right? For every currency pair, the first, okay, let's give an example here. So euro versus US dollar. I'm going to make this a bit very big because I want to explain something here. Now, for every currency pair, right? Pairs when you are trading Forex, you are really comparing two currency pair. Now, the first currency, right? For instance, this is an example here we're giving. We are comparing the euro versus the US dollar, right? We are comparing the euro versus the US dollar. For every currency pair, the first currency, right, is called the base, while the second currency is called the quote currency, right? Even though they have their individual name, this one is the euro and this one is the US dollar, but this first currency pair here, this first currency is called the base, while the second currency is called the quote. So I just want you to have this in mind as well. So here it's called the base currency. Why here? Let me make this more bigger. Right here, it's called the quote currency. This is our quote currency. So now this is the first currency is the base currency, while the second currency is called the quote currency. I just want you to have this at the back of your mind. So whichever currency pair, just know that just have it in mind that the first currency is called the base currency, while the second currency is called the quote currency. So when you're comparing currencies like this, if you want to, let's say you want to enter for a buy, you're trading US dollar versus you're trading the euro versus the US dollar, and you are buying, it means that you are saying that you are predicting, or let me use the word, maybe you are betting or predicting that euro is going to be stronger than the US dollar at this particular time. So you are buying you are buying what of euros. While when you are selling euros, what you are simply saying is that you are betting or you are predicting that the dollar is going to be stronger than the euro. So you are selling the euro, right? I don't know if you understand. You are selling it. So that means at this particular time, when you are selling, meaning that you are executing a sell, meaning you are selling you are selling the euros because you are believing that the dollar is going to be stronger than the euro. Okay, let me come again. Now, the first currency is called the base currency, while the second currency is called the quote currency. Just have it in mind. Though they have the individual names, like this is the euro versus the US dollar, right? But for every currency you are pairing, if you are pairing the New Zealand dollar versus the US dollar, this is the first one is called the base currency, while the second one is called the quote currency. Same thing with here. The first one is the quote currency, while the second one will be the first one is the base currency, while the second one will be the quote currency. Same thing here. The first currency is the base, while the second currency is the quote currency. So let's say we're trading the euro USD, right? So when you're trading any currency pair, for example, Euro USD, what you're actually is doing is that you are saying that the euro is going to be strong as at this particular time, and the US dollar is going to be weak as at this particular time. So you are now executing a buy order for the euro, right? So you're saying euro is going to go up while the dollar is going to be weak at this particular time. I don't know if you understand. So in other words, if you believe that the US economy will continue to be weakening, which is bad for the US dollar, right? If the economy of the US, you believe that it's going to be weakening, and meaning that for the economy of US dollar, US to be weakening, meaning that this is bad for the economy of that country. So you execute a buy. That means you are executing buy Euro USD order. By doing so, you have bought you with the expectation that it will rise versus the US dollar, right? So let me come again. Now, when you're trading any currency pair, right? Any currency pair. So the example I give you here is the euro versus the US dollar. Now, what you're actually doing is that you are saying the euro is going to be strong as at this particular time, and the US dollar will be weak as at this particular time. So you're executing a buy order. That means you are buying euro USD. Whereas when you're selling euro USD, you are simply saying that the euro is going to be weak as at this particular time, and the dollar will be stronger than the euro as at this particular time. So you're executing a sell order. I hope you understand this. So now let's give an example of let's give an example of USD JPY. Right. So as I said, the first currency is the base currency, while the second currency is the quote currency. Just have it in mind. Now, this is a Forex pair, right? This is a Forex. So in this example, right, the US dollar, which is the base currency, and the second currency, which is the quote currency. So I told you, for like, you are only executing for either you buy, it's either you want to buy or you want to sell. So now, if you think that the Japanese government is going to weaken the yen in order to maybe help its export industry, like export outside the country, you would execute a buy for the US dollar, right? Because you are buying, or either you're buying or you're selling. So let's say you believe that the Japanese yen is going to be weak. Maybe the government are going to probably weaken the currency in order for them to be able to export their goods to other countries. And you believe that this is going to weaken the economy of the Japanese yen. So you execute a buy USD JPY, meaning that you're saying the dollar is going to be stronger than the yen based on this news that you have, that the economy of the Japanese yen is going to be weak, or the Japan is going to be weak. So you are now buying USD, worth of USD, believing that, or with the expectation that the is going to be stronger than the Japanese yen. So, but when you're selling USD JPY, it means that you're saying that the US dollar is going to be weak while the Japanese yen is going to be strong. So you are now selling USD JPY. So you can give example of other currency pairs like GBP, maybe GBP, GPUSD, or depending on how you want to put it, just compare them and you also understand. So when you're buying, you're simply saying that if you're executing a buy order, you're simply saying that the buy order, which is the first, consider buying and selling. So that means you are saying that, or you are believing that the British economy will continue to do better than the US economy. So in terms of maybe economic growth, so you execute a buy GBP USD order. By doing so, you have bought pounds with the expectation that it will rise versus the US dollar. Why? If you believe that the British economy is slowing while the American economy remains strong, right? Maybe like the rock, or like a rock, right? You believe that the US economy, the Great British or the British economy is slowing, I believe that the US dollar is becoming strong, maybe like a stone or whatever you want to call it. So you now execute a sell GBP USD order. By doing so, you have sold pounds with the expectation that it will depreciate against the US dollar, meaning that you're saying that, okay, since I'm executing a sell, that means the US dollar is going to be stronger than the British pound. So you can give example of any other one you want to. So I want to also talk about something very quick. and then for round it up because we just have like maybe few minutes, less than maybe 5 minutes now. I want to talk about how to read Forex pair. Let me just quickly write that. How to read Forex pair. So I've talked about this on the first video, but I just want to really talk about it now because um I want us to cover up as fast as possible. So now how to read Forex pair. Now Forex pair are two different currency compared side by side. Right? There are two different currency compared side by side. And I've give example. This is our first currency, this is our second currency, right? This is our first currency, this is our second. So we are just two currency paired side by side, right? Now, you may not know what this mean. Like maybe when you're seeing that, yes, you have heard that I've said the first one, this is a Great British pound, the second one is the US dollar. But do you know that the first two letter of this currency pair, right? The first two letter, okay, let me use the first two letter, which is this, oh, sorry. Okay, let me just delete that. Do you know that the first two, which is GB, is the name of the country, while the third letter is the currency, the name of the currency they are using. So, for instance, GB, the GB means Great Great British, sorry, Great British. And what did they use in their country? They use the pounds. So let's give an example of the US. So the US, which is the USD, the US stands for the United States, United States, and the last pair, which is the third one, is the name of the country currency, which is the dollar. So they use the United States dollar. So an example, so let's use Nigeria. So NG, right? It's supposed to be NGN, right? So NGN, but NG is the name of the country, which is Nigeria. While this third letter, which is the last N, is last N, so is the Naira. So we're using the Nigerian Naira, right? So let's use CAD. The CA means the Canada, right? And what did they use in their country is the dollar. So that's the Canadian. So let me just put this Canadian dollar. So I hope you understand this. So, but there are two exceptions, right? The exception we have in this list are the euro, right? The exception to this list are the euro. That's the euro. And then the second exception is this. So the euro is because, there I think about two or three countries or how many countries came together to form the euro. So it's called the eurozone, right? So this is an exception to this list, and the CHF as well. So this is also an exception. So because this um the CH stands for Confederation Helvetic, something like that. But what they use is the Swiss franc, because I think it was like two countries or so that came together to form this CHF country also. I can't really remember, but that's what it is. And all these things you're seeing, like how it is being called, right? How it's being called is actually formed, or this dictation of each of these pairs, how they are being paired, is actually formed by ISO. The ISO stands for internal, how do you call this? Let me write it down. Sorry. The ISO, they are the one that is just like a body that actually denotes how to pair all these currencies so that they can do business worldwide easily without having to maybe having issues with. And so the I is international, the S ISO, international organization, inter- international organization for standardization. I mean, ISO, I think international organization for standard. I don't know if I really spell it this way. Standardization. So these people are responsible. Let me just drag that. So these people, they are responsible. Let me drag that. So they are responsible for creating this standardized code, such as the three-letter word, which used to represent the name of a country or the currency of that country go globally, right? So for example, the CAD, the Euro, the CHF, the NGN, the US dollar, the Great British Pounds, the Japanese yen, the Australian dollar, the Indian rupees, the South African rand, the Turkish lira, the AUDSD. So all this ISO, that is International Organization for Standardization, they are the people, or they are the ones who are responsible for creating this standardized code, such as the three-letter codes, which are used to represent currencies globally, right? So I think we're really done for today. So I hope this is clear. I just wanted us to cover up this, and I think we'll be having um about 2 to 3 more classes, because I was thinking of bringing up something, right? I was thinking of bringing up something, so that's why we are learning, we are also earning. So I think after the two, maybe between 2 or 3 more classes, I will introduce us so that we can start trading, right? I'll be dropping signals in the Telegram group, so that while we are learning, we're also earning. At least that one will serve as a motivation. I just thought about it recently, and it looked like it was going to really make sense. So this is just the part six, I think part six of this class, right? Part six, right? So that's where we'll be stopping for today. So if you have any question, please you can leave it in the comment section, or you send it to the group. I'm going to reply every single one of it. And if you also want me to do videos about some particular topics as well, you can also reply and get back to you. So before you watch this video, which is the part six, why I think I'll suggest you watch this. So this is, you can just search on this my YouTube channel, and then you can watch this, or you maybe get hands on this one, beginner joint first aid. You can start, or you start from here, but I think I'll suggest you watch this one right before here, and then watch this introduction to candlestick part one, introduction to candlestick part two, introduction to candlestick part three, introduction to candlestick part four, chart patterns part five, and then I'll be dropping this same currency pair or forex pair as the part six. So I'll also be dropping part seven continuously. So let's see how far we can cover. So if you like this content, especially from my YouTube community, if you like this content, please just leave a comment section. And the best way you can support this channel, if you like this content we are doing and you want more of it, the simple way you can do it is to like, comment, and share, as well as subscribe, and also share to your friends, share to people that you know that they will need this content, right? That they will need this content, so that to be a motivation to us. And another way you can support us is, maybe if you want to donate to our community, right? We'll have our official number, our official WhatsApp number will be dropped in the description below. So with that being said, guys, and also if you want to subscribe to my Telegram channel, right, you can just, here is the Telegram, just search for Slay Side Trading Academy, right? We drop beautiful contents on the Telegram group, right, or Telegram channel. So do it to participate as well. Let's see how we are going to be making some cool bucks from it. So with that being said, guys, I'll see you on the next video, which is be the part 7, right? Part 7. So don't forget to like, share, subscribe, and turn on your notification button to receive more content like this, right? So with that being said, guys, I'll see you in the next class of the next parts. Peace out.